Welcome back to the deep dive. Today we're tackling a term that, if you work in any large or even a scaling company, you have definitely heard it.
Oh, for sure.
Enterprise resource planning, ERP.
The big one, the scary one.
Yeah, and for most of us, I think it just conjures these images of, massive, expensive, really intimidating software.
You think SAP, you think Oracle.
Exactly, and you think of these endless implementation projects that they suck up all the budget and take years.
And that right there is exactly where most businesses get it wrong.
Right.
It's the core idea from the material we pulled for this deep dive.
Okay.
The software, the tech itself, yes, it's complex. But the critical insight is this. ERP is not just software.
Right.
It's fundamentally a business operating system. It's a way of thinking designed to turn all that corporate chaos into real functional clarity.
Okay, let's unpack that immediately because that changes the entire mission here.
It does.
Our sources, they really emphasize this core idea. ERP success is 80% business clarity and only 20% technology.
80-20. And it has to be in that order.
So we are not here to talk about coding or servers today. We're here to figure out what that 80% actually means.
And why it's so hard to get right.
Yeah, and how focusing on that business alignment first is really the only way this works.
Because if you reverse that ratio, and so many companies do, you fail.
What does that look like?
You buy the biggest, shiniest piece of software first, then you try to jam your existing messy business processes into it.
And it doesn't work.
It never works. You just end up with really expensive, high-tech confusion. So we need to get past the jargon and see how this whole thing lets a company think and act as one single entity.
To really bust that jargon, I think we need to start with the simplest analogy we can find. So let's forget supply chains for a minute.
Okay.
And let's picture Rhea. She's 5 years old, and she is living in a pre-ERP world.
Rhea in chaos. I like it.
Total chaos. Her toys are scattered in 5 different rooms. Her school stuff, like her PE schedule, her reading list, it's on 5 separate little scraps of paper that get lost.
And her mom packed her bag yesterday, so Rhea has no idea what's actually in there.
Exactly. So she spends 20 minutes every single morning just panicking. She can't find her shoes. She can't find the right book. She's confused. She's stressed, and she's always late.
That is the perfect corporate parallel. That's the island mentality right there.
Explain that.
Without ERP, money lives over in the finance department. Materials live in the warehouse. And customer orders, they only live with the sales team. They're all on their own little islands, and they only talk through, messy emails or someone manually typing things in.
Okay, so now let's give Rhea the ERP mindset.
Right. So now Rhea has one box for all her toys, one single bag for all her crayons, and one diary for her entire school schedule.
So her day just flows.
It flows smoothly. She knows instantly which toy is where and when she has school. Everything is synchronized. It's visible in one spot.
And the business parallel is it's so powerful. With ERP, everything, money, people, materials, orders, they all live in one smart interconnected system.
So when a sales order is placed,
The system automatically checks inventory, it updates procurement, it creates the financial records. There's no guessing.
no searching. The friction is just gone.
Right.
It's all about synchronization, not just, storage.
Right. So to really build on that, let's define the key concepts, the foundation of that 80% clarity rule.
Okay, so you hear a term like integration. In plain English, that just means departments and their processes are talking to each other automatically, instantly. It kills the manual handoff.
And then the most important one, I think, the one that prevents all those boardroom arguments, is the single source of truth.
Yes. This is everything.
This means there can't be conflicting numbers. Finance can't say, we did $1 million in revenue, while operations is swearing they only shipped $800,000 worth of goods.
Everyone sees the exact same number because it's recorded one time in one system. End of story.
And that is all supported by real-time data.
The numbers are updated the second something happens, not from a spreadsheet someone emailed at 5 p.m.
So our sources kind of boil this all down into what they call the 3 critical principles, and they highlight what the system doesn't do, which I think is just as important.
Oh, absolutely. The first principle, ERP doesn't make decisions for you. It makes decisions possible. It gives you that foundation of truth to act on.
Okay.
Second, and this is a big one, it doesn't necessarily reduce your total workload. What it does is it removes the confusion. It removes that awful administrative work of trying to reconcile conflicting data.
And the third principle, which ties right back to our 80-20 rule.
Right. ERP is not software. It is how a company thinks and acts and operates as one integrated enterprise.
So if we accept that, the next question is, what does it look like when they aren't thinking as one? What does that messy, fragmented flow actually feel like day to day?
Let's walk through it. A standard business process like fulfilling a customer order without ERP.
It's all friction and delay, right?
Totally.
Yeah.
Sales enters the order into their own CRM spreadsheet.
Right.
2 hours later, maybe, they email operations the details. The next morning, the warehouse team has to physically go check the inventory.
Like walk the floor.
Literally walk the floor, count boxes. Then they email procurement, an update. Procurement sends out a purchase order, maybe by fax.
People still use fax machines.
You'd be surprised. Or email. And finance, they only find out about the cash flow impact at the end of the week.
So the total speed of that transaction from order to, let's say, management confidence in the numbers is what, 5 days?
About 5 days, yeah. And errors just multiply at every single one of those manual handoffs. It's slow, it's inaccurate, it's incredibly stressful for everyone involved.
Okay, so now compare that to the integrated flow with ERP. This is the big shift.
This is the shift from 5 days to 5 minutes. The second that order is entered into the single ERP system, boom, multiple updates are triggered all at once.
So the system automatically checks the inventory.
Instantly.
And if stock is low, it just generates a PO and sends it to the supplier. No human has to write that email.
Bypasses the human chain entirely. And at the same time, finance instantly sees the future accounts receivable from the sale and the accounts payable from that new PO.
The results seem pretty obvious.
They're undeniable. The speed drops from days to minutes. And accuracy, that's the big one, it jumps from maybe 85% to 99+%. You just eliminate human error in reconciling data.
Which brings us to, I think, the most powerful story in our source material, the CFO's Monday morning reality.
Yes. This anecdote just perfectly captures why that clarity, that 80%, is the whole game.
So paint the picture for us pre-ERP.
Okay, so the CFO walks in at 9 a.m. on Monday. Immediately, her inbox has 3 conflicting reports.
Oh, no.
Sales is emailing saying revenue's up 25% this week. Great news. But operations is saying inventory is critically low and they need to halt shipments.
Okay, so that's a problem.
And finance is flagging that the cash position is suddenly pretty concerning.
So she's just plunged into a confusion loop. If sales are up, why is cash tight? Are they selling things they don't even have?
Exactly.
Yeah.
She spends the next 3 hours, her whole morning, on the phone, calling department heads, trying to reconcile this fragmented truth. She is working completely in the dark, just trying to figure out what happened last week.
What does she eventually find out?
She finds out that, yes, sales booked 1 million in new orders,
Yeah.
but they only have 600,000 in stock to ship right now.
So $400,000 is now just backlog.
It's backlog. The cash for it won't arrive for 30 days, but the company still has to pay its suppliers this week. The lack of connection between those 3 islands just created a full-blown crisis.
Okay, now let's run the tape again. Post-ERP.
Same situation. CFO walks in. It's 9:05 a.m. She opens a single dashboard.
And it's all there.
Instantly, she sees orders are up 28%, but that has driven the backlog up to 550,000. So yes, inventory is below the safety threshold.
Okay.
But here's the critical piece of information. She also sees that 40% of the company's accounts receivables are overdue.
So the dashboard doesn't just show the problem, it shows the cause.
Instant causality. The cash pressure isn't a sales problem. It's a timing mismatch. It's caused by slow collections and inventory needing to be replenished.
So she knows exactly what to do.
At 9:30 a.m., she calls the collections team, not the inventory team. She tells them to focus 100% on accelerating that 1.3 million in overdue payments.
And the cash problem is solved by Wednesday.
The whole shift is that her role fundamentally changes. She is no longer the keeper of financial records, stuck in the past.
Right, she's not an investigator.
She becomes the chief decision officer, acting proactively on real-time data to stop a cash crisis before it even really starts. That visibility, that is the ROI.
Well, speaking of ROI, that clarity has to translate into some hard numbers. I mean, if the business is thinking as one, what do the sources say about the actual quantifiable changes? What's it look like on a balance sheet?
The operational improvements are, they're dramatic. Let's look at a few key areas. First, the month-end close.
Always a stressful time.
The worst. That time speeds up by 50%. We're talking about going from, say, 10 or 12 days down to maybe 4 to 6 days.
That is massive for reporting and forecasting, but Okay, let's talk about accuracy. You mentioned inventory accuracy jumping from the low 70s to almost 100%.
Yeah, 97% plus.
Why is that gap from 70 to 97 so huge in the first place?
Because without integration, inventory is tracked manually or in disconnected spreadsheets. Humans make mistakes. They miscount, they record a shipment that didn't actually leave, they forget to log waste.
So 70% accuracy means 30% of the time the system is wrong?
30% of the time, your system thinks you have something you don't, or vice versa, which just kills customer trust and forces you to do these expensive manual spot checks all the time.
And ERP fixes that how?
It forces the data to be tied to a physical action. You scan a barcode when a box moves. A sale is logged instantly when it happens. The system reflects reality.
That makes perfect sense. The cost of fixing those errors must just be astronomical.
It really is. And there are other speed gains. Invoice processing time. That's typically 90% faster.
90%.
Yeah, from days down to same day.
Yeah.
Because the system can validate the purchase order and the receipt automatically. And order fulfillment time, that drops by around 70%.
So when we look at the pure financial side, what is the typical payback on one of these systems?
The average ERP investment generates about a 150 to 200% return over 3 years.
So if a company invests, say, $4 million,
Using the example from the sources, that $4 million investment, which sounds huge, it pays for itself in just 20 months. And by year 3, it's generated a net positive impact of over $2.2 million in profit.
so that's the direct ROI, the speed, the efficiency. But our sources really stress something they called the hidden ROI.
Yes, the cost of problems that never happen.
That feels like the most underrated metric of all.
It absolutely is, because risk avoidance is where so much value is. I mean, ERP is a premier risk mitigation tool.
How so? Give me an example.
Okay. It prevents costs like, say, $1 million a year in just rework, because automated validation stops billing errors before they go out.
Okay.
It prevents $500,000 a year in write-offs from inventory going obsolete, because you have real-time visibility into what's been sitting on a shelf for too long.
And then the big one, compliance.
The huge one. It builds in automated audit trails and controls, which can mitigate the risk of these massive multi-million-dollar compliance fines. You're not just getting more efficient. You are stopping the business from bleeding money through systemic mistakes.
So if the numbers are this clear, I have to ask, why do we always hear about massive ERP failures? If the ROI is so certain, what's the big trap that companies fall into?
That is the essential question, right?
Yeah.
They fall into the trap of reversing the 80-20 rule. They buy the software first.
They focus on the 20%.
Exactly.
Yeah.
And the failure pattern is almost universal. Company buys the massive, expensive platform. The IT team implements all the features perfectly. And
And the
then
users don't adopt it.
the users don't adopt it. The people on the floor who have to use this thing every day, they go right back to their old spreadsheets because the new system doesn't fit the way they actually work.
And if they don't use it, the data gets fragmented again.
And your single source of truth just collapses.
Yeah.
The ROI never shows up. And this is why we have to understand that ERP as a concept is system agnostic.
It doesn't matter if it's SAP, Oracle, NetSuite.
It doesn't matter. That's layer 5. The software is just the vehicle. The underlying logic is universal. Order is placed, inventory goes down, APO is triggered, finance is updated.
So to make sure that 80% clarity is actually achieved, we need a framework. And that's where this IR4X 6-step method comes in. It forces that business alignment first.
Yes, this is a roadmap to avoid that tech-first catastrophe.
Okay, so let's walk through it. Step 1.
Step 1 is critical. Identify the real pain points, not the IT wish list.
What's the difference?
A bad approach is the IT department saying, we need better reporting capabilities. The good approach, driven by the business, is realizing our cash forecasting is pure guesswork because we have no visibility across sales, inventory, and payables. You start with the pain that's hurting cash flow or your customers.
And step 2, this feels like where the rubber really meets the road. Map the real processes, not the perfect ones you see on a PowerPoint slide.
This is where so many projects die, because they automate a broken or, worse, an idealized process that nobody actually follows.
So you have to watch how work actually happens.
You have to, including all the informal workarounds, the little human hacks people invent to get their jobs done.
There's a great example of this in the source.
The texting example.
Yeah.
The official process says sales enters the order and waits for the system to reply.
But the real process is the salesperson texts the warehouse manager directly and says, hey, do you actually have this in stock right now? before they close the deal.
Right. And if your new ERP system doesn't account for that human need for speed, by giving them, say, mobile real-time inventory visibility, the sales team will just ignore your shiny new system and keep texting the warehouse.
That is the perfect definition of a failed implementation.
It is. So, step 3 is just as vital. Define required capabilities and phase the implementation. Don't try to boil the ocean.
You solve the highest pain problems first.
Exactly. A smart phase 1 might just be finance and procurement for the first 4 months. That fixes the worst problems first. Your month-end close time and your cash visibility. You get immediate, measurable wins. It builds confidence.
And step 4 follows right from that. Integrate data flows.
This is the technical part, but it's still driven by business clarity. You design it so one single business trigger causes multiple automatic updates. You're not just installing modules, you are building the connections that get rid of the islands.
Okay, so now we get to the people part, the 80% that often gets ignored after you go live. Step 5. Train by role, not one size fits all.
Right. If you put the CFO and an accounts payable clerk in the same training room, you are just wasting everyone's time.
So the CFO's training is about dashboards, decision-making.
And the AP clerk's training is laser-focused on processing an invoice correctly. The structure has to be, why are we changing? How does my job fit into this new flow? And then finally, the hands-on clicks in the system.
The source material suggests putting aside a pretty big chunk of the budget for this, 15 to 20%, just for training.
That shows you how seriously successful companies take user adoption. It's not an afterthought.
And finally, step 6, the long view.
Measure and optimize. Go live is the start of the journey, not the finish line.
So success isn't just that the system is on, it's about tracking those core metrics, inventory accuracy, close time, and critically user satisfaction over months 1, 3, and beyond.
And the final major implementation error to avoid, which really undercuts this whole framework, is rushing the go live.
Just to hit a date.
To hit an arbitrary date, no deadline is more important than stability. A delay is always cheaper than launching a broken system and spending 6 months cleaning up the mess.
This whole framework just brings us full circle, doesn't it?
It does.
ERP is not some heavy, scary technology. It's a way of thinking. It gives you one integrated system, one source of truth, and it creates clarity out of all that chaos.
It takes you from Ria's messy toy box to a business where everyone knows, instantly, what's coming in, what we have, what we owe, and where the cash is.
And that visibility, that's what lets the business change how it operates. The true success, the strategic ROI, it isn't just the millions you save or the 70% faster fulfillment time.
The ultimate payoff is shifting from being reactive to proactive.
Explain that difference.
The reactive business, they investigate a 2% drop in gross margin after the quarter is already closed. The damage is done.
Right.
The proactive company, armed with this real-time integrated data, they see a 1.5% margin drop happening in week 3 of the quarter.
So they can act on it immediately.
They adjust pricing. They negotiate better supplier terms right then and there. They make sure the margin is fixed by the time the quarter actually ends.
That strategic agility, that is the real prize for mastering that 80% clarity rule.
Absolutely. The real value isn't just in the costs you save. It's in the crises you prevent and the opportunities you seize.
It really makes you wonder, where in your own organization or any company you deal with is the data still living on those isolated islands? And what steps could be taken to demand that kind of strategic, unified clarity? Thank you for joining us for this deep dive.